Hello everyone, I am Dr. Soundararaj. I am happy to interact with you through this video. In this video, I am going to take you through yet another problem related to the preparation of a cash flow statement under indirect method of Accounting Standard 3 of India. These are all a few details related to my career. After you watch the full video, if you really like the video, give a like to the video and do subscribe my channel so that you can get the updates of the new videos which I will be releasing. Let's look at the problem. From the following information of Sun Mills Limited, prepare cash flow statement. Balance sheets of Sun Mills as on 31st March 2016 and 2017 are presented. The values are given in lakh rupees. Let's look at the items in the equity and liability side. Equity and liabilities. Number 1, shareholders funds, under which you find share capital. The detail of the same is given according to note number 1. The opening value of share capital is 1,400 lakhs and the closing value is 1,300 lakhs. Let's have a look at the details of note number 1. Note number 1. You find two types of capital with this company. One is equity capital with the opening and closing of same 1,000 lakhs, whereas you find the other item 10% preference share capital, opening of 400 lakhs and the closing of 300 lakhs. If the problem is silent about the payment of preference dividend, obviously we need to calculate preference dividend at the rate of 10% and the same has to be paid to the preference shareholders. If we are specifically directed regarding the payment of dividend in this problem, we will go by it accordingly. Then next, another item under shareholders funds, which is nothing but reserve and surplus. This includes the profit and reserves as well. Opening is 4,000 lakhs and closing is 4,700 lakhs. Current liabilities are presented. Short-term borrowings, opening 600, closing is 200. Trade payables 400 and 500. Now let's look at the asset side. Non-current assets have got two items under which you find fixed assets first. The details of fixed assets are presented in the problem according to note number 2. The opening is 2,400 and closing is also 2,400. Non-current investments, you find 200 opening and closing 300. Let's have a look at note number 2 first, then we will go through the rest of the items in the asset side. Fixed assets, according to note number 2, you find tangible assets with the opening of 3,400 and closing of 3,600. From the balances, accumulated depreciation on the fixed assets are subtracted. The opening balance of accumulated depreciation is 1,000 lakh and closing is 1,200 lakhs. Therefore, you are given with the cost value of the fixed assets. Opening and closing both are 2,400 lakhs. These are all the details you find according to note number 2. In relation to fixed assets. Let's look at point number 2 under asset side, current assets. You are given with the inventories, trade receivables, cash and cash equivalents, short-term loans and advances. My point here, among those 4 current assets presented, you should consider the current assets other than cash and cash equivalents and find the changes in the values of those current assets that are to be adjusted duly with operating profit before working capital changes under cash flow from operating heading in cash flow statement. Then regarding current liabilities, the changes in the current liabilities, both the short-term borrowings and the trade payables, the changes in these values should also be adjusted with the operating profit before working capital changes in the cash flow statement. Then let's look at the next statement presented in the problem, which is nothing but statement of profit or loss for the year ended on 31st March 2017, which is a current year. Here also the amounts are presented in lakhs. Revenue from the main operation, it comes to 2,800. The second category of revenue is nothing but other income, dividend income of 1,000 lakhs. This is a non-operating income to be subtracted from the profit before tax and extraordinary items to calculate the operating profit before working capital changes, because this is a non-operating income. Then regarding expenses, cost of material consumed is an operating expenditure, so you just ignore it while you prepare cash flow statement. Employees benefit expenses are also operating and cash expenses. Ignore this item also. The next one is finance cost, interest paid. Interest paid could be an operating expenditure for finance nature of business. For non-finance nature of business, you find this item is an item of non-operating item, it has to be adjusted with the net profit before tax and extraordinary item to calculate the operating profit before working capital changes. This is point number 1. Point number 2, this is an item of cash outflow through financing activity, and therefore this has to be recorded under financing activity of cash flow statement as cash outflow. Depreciation, though it is an operating expenditure, it is a non-cash expenditure, therefore to be added with the net profit before tax and extraordinary item to calculate operating profit before working capital changes. Loss due to earthquake, this is an extraordinary item. This has to be first added with profit after tax to calculate net profit before tax and extraordinary item, followed by, before you calculate the cash flow from operating activities, this item has to be subtracted again. This is a treatment with regard to loss due to earthquake and extraordinary item given in the problem. Next, you are given with the profit before tax, which is amounted 1700 lakhs, followed by you find tax provided and paid amounted 1000 lakhs. The tax provided has to be added with the profit after tax to calculate profit before tax and extraordinary item. This is step number 1 with regard to the provision for tax and tax paid. Number 2, the tax paid amount has to be subtracted from the operating profit to calculate the cash flow from operations in cash flow statement. Finally, you are given with the profit after tax. This is going to be the starting point for our calculation in our move to prepare cash flow statement under indirect method as per accounting standard 3. Additional information number 1, no dividend paid by the company during the current financial year. The point is so simple. Let us not further ask any questions with regard to this particular point. Just go by the problem. If the problem instructs you to do certain things, you follow the direction. So here you forgot about the dividend to be paid to the preference shareholders, the dividend to be paid to the equity shareholders as well. Number 2, out of fixed assets, land worth 1000 lakhs was sold at its cost. So fixed assets has got two different elements of assets. In that, one element is named land. So land costing 1000 lakhs has been sold without profit and loss. This is an item of cash inflow through investing activity that would be taken over to cash flow statement. Now let's have a look at the workings first. First, we will find out how net profit before tax and extraordinary items are calculated. 700 lakhs of rupees is the profit after tax according to statement of profit or loss in the problem. Please have a look at it. See, this is what. With that, they have added the tax provided and paid amounted 1000 lakhs. With that, they have also added 1100 lakhs, which is nothing but the loss due to earthquake, which is an extraordinary item. And finally, they have calculated 2800 lakh rupees as net profit before tax and extraordinary items. This is number 1 working. Let's go through accumulated depreciation next. Accumulated depreciation on fixed assets being a credit account, the opening balance of the same has to be written in the credit side of its ledger account. That is why it is written in the credit side as balance brought down 1000 lakhs. Obviously, the closing balance of the account should be written in the opposite side 1200 lakhs. According to the statement of profit and loss, they have made a provision for depreciation amounted 200 lakhs this year on the fixed assets. So the journal entry for it, statement of profit or loss account debtor to accumulated depreciation on fixed assets account, and the posting is made in this ledger. Opening is 1000 lakhs. A new addition which has come into this account in the name of current year provision for depreciation 200 lakhs. So the total what we expect as closing balance in this ledger is 1200 lakhs, and the same is available. So therefore there is no hidden information in accumulated depreciation account. Next, let's go through the fixed assets account. Fixed assets being an asset, the opening balance of this particular account should be written in the debit side. See, balance brought down. What is this 3400 lakhs? This is a cost value of the fixed assets. How do I say that? Look at note number 2. These closing values are book values. What about these values? The 3,400 lakhs and 3,600 lakhs are the cost values. You are advised to open the fixed assets account only at its cost value when there is a provision for depreciation account maintained for it. So 3,400 opening, 3,600 lakhs is a closing, and that is what considered in its ledger account. See, opening 3,400, closing 3,600. We were also informed through the additional information that an asset named land sold at its cost value of 1,000 lakhs. The journal entry for it, cash account debtor to fixed assets or land account. Here land is not separated, it is grouped together with the fixed assets. Conceptually speaking, land has to be kept separately. When you maintain provision for depreciation on a fixed asset, it has to be separated from the total value of non-current assets in the problem. So here there is a small conceptual mistake according to my understanding. However, it doesn't affect the way you solve the problem, and that is why I am also taking you through this. Please try to understand that. My suggestion is that for every non-current asset, you need to maintain separate provision for depreciation. That is what conceptually correct. And more specifically for land, you don't require to maintain provision for depreciation. Here it is grouped together. However, this particular error committed in the problem doesn't affect the way we do problem, and that is why I am also explaining it. Please try to understand. So cash account debtor to fixed assets, that is recorded here. Now you look at the problem. Opening was 3,400. After you sell land costing 1,000, the closing is expected to be 2,400. But what is the actual closing in fixed assets at cost account? 3,600. You find an increase of 1,200 lakh of rupees in this account. If you find increase in a non-current asset balance, which is nothing but purchase of the non-current asset, that could be the only reason for having increase in the value of a non-current asset in cash flow statement problem. So therefore, journal entry for purchase of additional fixed asset is nothing but fixed assets account debtor to cash account. So this is an item of cash outflow through investing activity which would be taken over to cash flow statement. This sale of land is an item of cash inflow which would be again taken over to the cash flow statement and recorded under investing activities. Now let's get into the statement of cash flow. Cash flows from operating activities, this is the first category of cash flows, under which net profit before tax and extraordinary item, I explain it according to working. Number one, it comes to 2,800 lakhs. We do adjustment for non-cash and non-operating items. The interest paid, which is a non-operating item, though it is a cash item, it is a non-operating item, and that is why I have specifically mentioned the reason why it is added here. So it is added. Provision for depreciation, though it is an operating item, it is a non-cash expenditure, and therefore it has to be added. Dividend income, it is a non-operating income, 1,000 lakh rupees, this has to be subtracted because very clearly it is stated it's a non-operating income. And we have calculated 2,200 lakh of rupees as operating profit before working capital changes. With that, we do adjustments for changes in current assets and current liabilities. Now I help you to recall the four formulae which I have explained in all my videos on cash flow statement. Kindly watch those videos as well to gain better understanding. I have given links of those past videos on cash flow statement in the description of this video. Please watch them. And more specifically, watch the video on the calculation of cash from operations, where I have very clearly explained the basis by which I have come out with the four formulae, which you need to know to understand why the change in a particular current asset or current liability is recorded as inflow or outflow of cash. What are the four formulae? Increase in current asset leads to cash outflow. Decrease in current asset leads to cash inflow. Increase in current liability leads to cash inflow. Decrease in current liability leads to cash outflow. These are all the four formulae based on which they have done adjustments for the changes in these current assets and current liabilities. Now cash generated from operations amounted 2,100 lakhs is calculated, from which we have subtracted income tax paid followed by we have done adjustment for the extraordinary item of loss due to earthquake, and that is also done. What is the resultant figure of the first category of cash flow activities, which is nothing but 0. So there is no positive or negative figure from the operations of the business. The second category of cash flows is cash flows from investing activities. You might recall what I said with regard to sale of land. 1,000 lakh rupees is a cash inflow. Purchase of fixed assets 1,200 lakhs, which we found out through preparing fixed assets at a cost value. Purchase of investment 100 lakhs. Let's have a look at the investments presented here. See, non-current investment. It was 200 in the year beginning. It is 300 at the year end. Therefore, they would have purchased the investment for a value of 100 lakh rupees, which is a cash outflow through investing activity, and that is recorded here. And finally, dividend received. Dividend received is a non-operating income. So this is a cash inflow through investing activities, that is recorded here. The resultant figure of the second category of cash inflows is 700 lakh rupees, which is nothing but cash flow from investing activities. The third category of cash flows is cash flows from financing activities. Interest paid 200 lakh rupees. The interest paid is very clearly given in the statement of profit or loss. See, finance cost interest paid 200 lakh rupees, and that is what treated as cash outflow here. Redemption of 10% preference share capital 100 lakh rupees. I explained it in the beginning. See, have a look at this. 10% preference share capital according to note number 1. Opening 400, closing 300 lakhs. Therefore, the preference capital worth of 100 lakh rupees has been redeemed during the year at their par value, and that is what the cash outflow through this activity recorded here. The resultant figure is net cash used in financing activities comes to 300 lakhs. Now you do the total of the outcome of all the three activities. Minus 300 plus 700, 0. You get the net value of 400 lakh of rupees, which is nothing but net increase in cash and cash equivalents during the year. With that, you add the opening value of cash and cash equivalents, which is 800 lakhs. You get the final answer of 1,200 lakhs, which is named to be the closing balance of cash and cash equivalents. Let us check whether these items are presented here in the balance sheet. Yes, cash and cash equivalents. Opening 800 lakhs, closing 1,200 lakhs. With that, the preparation of cash flow statement comes to an end. I hope I have explained the preparation of cash flow statement clearly. I also understand that this video could be useful for the learners to understand the step-by-step procedure of preparing cash flow statement in a clear way. Thanks for watching this video. We will meet in the other video.